Right, hello everybody. Welcome to today's podcast. It's the 15th of May 2023. My name is Adrian Boothie. I'm the head of trading here at Trendsignal. I'm joined today as ever with Jerry Miller, who's our managing director. Hi, Jerry.
Yeah, good morning, Adrian. Morning all.
Good. So let's we sort of not had a podcast for a couple of weeks with various sort of bank holidays and a coronation here. So probably a little bit to catch up on. So Jerry, do you want to just take us through a little bit about what's been happening? Particularly lot to do with interest rates at the moment and the impact it's having on the markets, please.
Yeah, it's all really central banks again, inflation readings and central bank action. Certainly here in the UK, it's been quite interesting. We had the what's called the Monetary Policy Committee, or MPC. That's the rate setting committee of the Bank of England, and they, like other central banks, they meet sort of monthly-ish. Have about 8 or 9 meetings a year, and they met last week and they delivered another interest rate increase to 4.5%. Totally expected, Adrian, but it was quite interesting to listen to what they had to say, because they actually warned that they would not hit the 2% inflation target until early 2025, rather than middle of the way through next year. And that's quite a big change, actually, because it really means that anyone who's looking for a dramatic shift back down in interest rates is going to be a bit disappointed. And the Bank of England cited really persistently strong food inflation. And I think we're all aware of it, Adrian. You only have to look at the BBC website. It's always talking about the food inflation. And food inflation actually is something I checked up on it. It was at 19.1% in March, food inflation. And that's basically a basket of all the food items that people purchase and consume, as opposed to the CPI, which is a basket of so many different things through different services and different products, etc., not necessarily food. Anyway, in the UK, 19.1%, but you compare that with the EU, which is 17.5%. And you're probably thinking, Jerry, that's not a big difference, really, is it? Is that the reason why we're so much worse here? Well, it does make a difference to the extent that it means our headline inflation rate is struggling to come down, whereas Europe's has come down sort of 1 or 2%, whereas we're stuck at sort of 10.1%. And it's really has an effect on us consumers. It basically means interest rates are not going to come down too quickly, and if anything, they've got further to go.
I mean, that's a staggering amount. I guess we've all felt it, haven't we, at the shops? Absolutely. So, how does that compare with the US? Are you aware in terms of the?
Well, the US inflation rate, as you know, that data from last week, the core inflation rate in the US, that's back down to 4.9%. I mean, it really is so much. It's chalk and cheese compared to the UK. Of course, what you have to realize is that there are other impacts on us. Food inflation. Brexit has caused significant additional costs to importing those type of foods into the UK. Plus, you've got transportation costs have gone up significantly. And I know you're probably saying, but hang on a second, Jerry, oil's come right down, so diesel and petrol are right back down. But this is lagging. I mean, I can show you graphs of raw commodities, the likes of wheat, corn, soya meal, and other commodities that have come down. But you wouldn't think so, looking at the price of bread or butter or anything. And the supermarkets have gone to great pains to say, "Oh, it's a lagged effect. It's a lagged effect." So, you know, you'll see it in a few months' time. But I tell you what, when the price of raw materials went up, wow, prices went up immediately in shops. But no, in the US, they don't have any of those problems, because remember, everything is priced in dollars, whereas we've got exchange rate issues. Think about what happened when the Truss Kwarteng government came in for those few weeks, the disaster that was. Sterling went down to 103 against the dollar. Imagine all those dollar price commodities, foodstuffs, all sharply higher. And from the EU, anything priced in euros, sharply higher as well. So we've got to contend with that. And that's one of the reasons why our inflation, our headline inflation, is a little more painful and a little more obstinate than European and US inflation.
So we're talking about this really. It ends up becoming a bit of an economics podcast at times, doesn't it? But I
Yeah, it
think that's
does.
because simply that interest rates are so important to the financial markets. You know, the movement in the currencies, the indices, heavily based on interest rate change or perceptions of interest rate change. So what are we thinking about likely changes going forward? Because of course, you know, that's where the pension funds, hedge funds start to reposition their portfolios according to the risk that of these changes, don't they?
Yeah. Well, if you think about it, the cost of money going up affects you and me, age, and any monies that we borrowed, our mortgages, anyone who's having to finance their mortgage, i.e., if they've got a fixed term coming to an end, they're going to be in for a very rude surprise because interest rates are sharply higher than when people last took out 2 and 5 year mortgages. And companies, they borrow money. So the cost of financing your company's operation now is a lot higher. If you need to borrow money to finance a new project, a new business plan, whatever, that comes at a significantly greater cost than it would have been a year and a half ago.
Yeah, absolutely. Okay, so why don't we have a quick look at what's happened with the markets themselves? So just a quick summary on the stock market, Jerry.
Yes, so equities last week, they were a bit mixed, really. I think whilst the inflation was a good number, it beat consensus forecast with a fall to 4.9% in the US. But I think, that's the effect of the Federal Reserve's really rapid tightening. You know, we had those 4.75% hikes last year, and that's really pushed their annual inflation right down from 9.1%, whereas we're not doing so well. The FTSE down 23 on the week, pretty much like the DAX, down 47. It's about 0.3% lower. The market that did stick out really positively, Adrian, was the Nasdaq. The
Yeah.
Nasdaq has done particularly well, performing better than what we refer to as the broad market, which is the S&P 500. And that actually, whilst it tacked on a modest gain of what was a 0.4%, the Nasdaq's been doing better ever since the first quarter results. All of those FANGs, they posted some pretty impressive results. And I think investors have been focusing on tech stocks rather than the broader market.
Well, you can see that when you look at the Nasdaq here. You can see we actually had a buy trade on the 8th of May, which is great. You know, really nice buying opportunity, and it went on and hit a nice profit for us. But if you compare that with the Dow, that's really over that week, it's been coming down fairly dramatically. I say
Yeah.
dramatically, it's probably not dramatic, but it's certainly a different direction than Nasdaq, that's for sure.
Yeah, the Dow, not everyone appreciates this, but it's literally only 30 stocks, and it's what's called price weighted rather than weighted by market capitalization. I won't go into too much detail, just to say it often trades differently to the S&P, the broad S&P 500 market, and the Nasdaq. And it's always curious that when you tune into the news or whatever, they always quote the Dow has done this, the Dow has done that. It's less relevant to most fund managers and traders who look at the S&P 500 and the Nasdaq more.
Yeah, absolutely. Okay. And for the currencies, Jerry, what's been happening with those?
Yeah, that was quite interesting actually, because the dollar registered its first sort of significant gains, gosh, all the way back to, if you look at the euro, it's probably the best one since mid-February, really. And I've sort of tried to look into the reasons for this, and I think a lot of it was really profit taking on dollar short. So a lot of traders were cutting some of their dollar short positions. What I mean by dollar shorts, where they've sold the dollar and bought the euro, or sold the dollar and bought sterling. And I don't think interest rate expectations were the cause, really, because if you look at the interest rate expectations, the market now, after the CPI data, the inflation data last week, if you look at what's happening now, so at the moment, interest rates are at 5 to 5.25. Go to November the 1st meeting. So it's almost targeting a half-point cut there. And then in December, if you click on the next meeting, it's a 3/4 point cut by year end, whether it's in 3/4 point cuts or whatever. But I always tell people, do not read too much into this, because this FedWatch tool is a minute by minute snapshot of the forward rates and what they're saying about future Fed policy moves. And it is a really fluid sort of picture, because if you think about what Jay Powell said, he's the chairman of the Federal Reserve, and he made it very clear when he was quizzed recently about interest rate cuts. He said, he and his other officials on the committee said that the prospects for future cuts in interest rates was very uncertain. And I know what he means, because you only need things just to turn up a little bit, and they're not going to be rushing to cut rates. And I think it was Jamie Dimon from one of the big banks in America who said that he didn't believe that they'd be cutting rates this year. So there's the market's telling us they are going to cut rates, but a lot of influential people are saying it's really uncertain. And I think you might see this picture change in the coming weeks.
I guess one thing that we can probably agree on is that the likelihood of further interest rates is lower in the US than it is in the UK, because obviously their inflation is significantly lower right now. So
yeah, I mean,
less of a problem.
Yeah, I mean, as you can see there, we've reached the top of the tightening cycle according to the markets in the US. In the UK, we had that rate hike from 4.25 to 4.5 last week. The forward interest rate contracts that are used by the city to predict where interest rates are likely to go suggests that, or imply that interest rates are going to get to 5% by third quarter. So unfortunately, we're not at the top of our tightening cycle here in the UK. And the reason is, you've just said it. Inflation's at 10.1%. But the bank, the Monetary Policy Committee did say that they expected inflation to fall to 5.1% by the fourth quarter this year. But that's quite a bit different than the 3.9% that they were predicting in their last meeting. So
it's also significantly above their target rate as well, isn't it? So
it's double. Yeah, it's double. That's right.
Okay. Good, Jerry. Anything else to add, or should we move on to what we've got for next week?
Yeah, there's not a lot coming out, but yeah, let's we can have a look at what's coming out this week. It's a bit of a sparse calendar, really.
Okay, so what we do now is take a quick look at the economic calendar. What are the main items that could be driving movement on the currency markets, the stock and commodity markets as well? So let's have a quick look at the calendar. As you say, it's not huge items this week, but there are some interesting ones. But Jerry, why don't you take us through maybe the top sort of 2 or 3?
Well, we've got two. We've got two that are linked. One today called the Empire State Manufacturing Index, and the other one that's closely linked to this is the Philly Fed Manufacturing Index, which is on Thursday. Both of these are a measure of how well, or actually how badly, the US manufacturing sector is doing. And you'll notice in the Empire State one, which is New York, just to be very clear. And New York State actually is a really big state, and it's got a lot of industries in it. And it's a key measure of how manufacturing is doing nationwide, really. And you'll see that there's a pullback in activity expected. So it was at 10.8 last month, and we're looking for it to contract now. So anything below 0 means it actually is contracting. And if you click on that little graph on the right hand side, you can see that it only had 1 month in the plus column, and it's due to go back into the negative column, which basically sums up what is happening in the manufacturing sector, which is really it's struggling from the rapid rise in interest rates last year. And that's really it. And you can see here, and the one you're looking at here with the Philly Fed manufacturing index, it doesn't look good at all. And of course, we've had another rise in rates to 5%, Adrian. So I think any chance that the manufacturing sector is going to improve in the US anytime soon looks pretty remote, doesn't it?
Yeah, absolutely. And this is the thing, when you're a trader, you don't necessarily, we share this information because I think a lot of people like to know kind of what's going on. As a trader, it's most important to know what specifically is being announced. You don't have to know everything about the economic side of it. What you have to be aware of is which items are likely to cause a big shift or burst of volatility, especially if you're a day trader, because what you don't really want to be doing is in a dollar trade, or perhaps in the S&Ps or the Dow at 130, because that can create a shock move that could really take your stop loss out and creates even slippage on the stop loss. So you've got to be quite careful of that. So part of this is just making you aware of what are the potential banana skins, what do you need to be aware of, And these two items are particularly important in what is, as I said, Jerry said, a quieter week.
Yeah, it is a quiet week.
Yeah, anything else?
Well, there are quite a few central bankers speaking, and that normally fills the calendar up when there's nothing else much to talk about. But the reason why we like to listen to what central bankers are saying is because they do let slip what they are thinking about future monetary policy, and that's what drives our markets, the indices, the currencies, commodities. It's so important to have an idea or a grasp of what's going to happen to interest rates, because as we've been speaking, a lot of dollar-based commodities, if the dollar strengthens, that pushes the price of those commodities down. And those interest rate expectations here in the UK also affect UK companies and UK consumers. So we're very interested in them. Would the pick of the bunch? Probably, maybe. I think Jay Powell is speaking on Friday. He's the chairperson or the chairman of the Federal Reserve. And I think the chairman has already said that this is about perspectives on monetary policy. So it's quite an interesting topic. That's what we want to hear about, monetary policy. Let us know what you're going to do with interest rates, Jay. We want to hear. But I think the chairman of the Federal Reserve is far less certain about the future rate cuts this year. And I think any clues to his thinking, I think it'll be quite interesting to hear them.
Well, that's the thing. And if you think of it in these terms, that, any clues that we have about interest rates means that the pension funds, the hedge funds, the real big players in this market, they're going to be repositioning their portfolios according to that risk. So the information that is said will create a reaction by big players, and it's that is going to create the movement that we, as then retail traders, can then get behind. It's that burst of speed, that burst of volatility that makes it very exciting for day traders to get on the back of that and to trade the sort of the ripples, if you like, that happen after, but also for end of day traders or swing traders as well. Jerry, that's great. Thank you very much for that.
Okay.
I shall move on. Let's have a quick look at some of the markets and what's been happening there. So a few things that I wanted to go through in terms of what we should be trading. Some really interesting results on our strategies over the last week or so. So definitely wanted to talk about those. But before that, just a quick look at some of the most popular markets there. So if I just bring my charts in, you have to excuse my voice, by the way, I'm a bit hoarse. So looking at gold, first of all, what we've been doing in these podcasts is talking about some of the major support and resistance levels that are taking shape really on these markets. When you look at gold, it is in a strong uptrend. You see that from the arrows on the left-hand side. The weekly trend's up, the monthly trend is up, which means the market is sort of ratcheting its way higher. What we've been talking about is some of the previous levels of resistance as this market's been going higher and the sort of potential reactions we might see. So looking at this level back from March 2022, we hit that level, market stopped, reversed back the other way, and actually going back a little bit further, forget these annotations on here, but you can see up at this level here, it's at 2052, the market hit 2052. And what you're looking for is that kind of whack-a-mole effect when it comes to resistance. You want to see, this is where my cursor is now. So we hit that on the 4th of May. And the market tried to get above it, even when as high as 2079, then came all the way back down, closing below 2052. This is a little bit like that game whack-a-mole. As I said, you've got that mole poking its head up, and then it's being smacked back down by sellers. So the reaction is coming off that major resistance level from a couple of years ago, but it's hit there and it's coming off from there, and it's led to quite an interesting short trade that we had last week. We didn't make huge amounts on that one. It's about 0.53% on that particular opportunity, but profit's a profit, and certainly rather have that than not have it, that's for sure. We're in a stage where now the market is sort of pausing for thought. Is this a correction? Is it a trend reversal? Seems like a correction at this point. So we are at this stage waiting for the next opportunity to buy. So, but we're sitting patiently waiting for those indicators to turn back from red to green. S&Ps, we've been following this for a little while actually, this 4160 level. It's stuck in a very tight range down from, as I say, 4160 or 70 down to 4050. Banging between there for the last month or so. This is the big number, 4160. A number of times we tested that level. Sound like a broken record. We keep doing it. We tried to get through it on the 28th of March, and came off it significantly there. To be honest with you, until we see a convincing close above 41.60, we are stuck in a range. So look out for that 41.60 down to 40.60, 40.50, around that sort of level there. Those levels remain strong on the broader S&P 500 index. Crude oil, I find this quite interesting one. Some really big sort of deep rotations there. No short trade brewing tonight there. So we're not looking at a sniper opportunity there despite a bit of a downtrend in play. So what does that mean? I'm kind of looking at this thinking about the next potential buy trade, because one of the things that I look at is when the markets are in those sort of stronger downtrends and then you start to see a higher low. So if we can see there's a low here back from the 4th of May. We've got the high here that's also the low here from today. If it forms a base and then starts to rotate back green again, I'm going to be quite interested in taking a buy trade, because what you'll be looking at there is the market breaking down. But at some point, if that trend starts to reverse, you're going to start to see, this is kind of where we are now. Will we start to see, like here, a higher low coming in? So at some point when this market starts to move back up, you're going to start to see a lead on that will be higher highs and higher lows starting to kick in. Is that what we're going to see next? I don't know. We need to remain patient ultimately, and we are going to find out on the charts over the next sort of week or two about that potential direction going forward. Couple of the currencies, pound against the US dollar, really interesting. Again, some of those levels a little bit like the gold one. We had to go a little bit further back for this one, but that 126.35, that's the key price from which we fell back in May last year. Big sell-off really taking place in there. We hit that number a few days ago. Again, like whack-a-mole, if you're thinking about what are those big structural levels, that's a big one. 126.35, we hit it. The head popped out of the hole, the burrow, and it got smacked back down again by sellers. That's where we are right now. So what do we think about that now? I think, look, you know, you're looking in terms of support levels down to around that sort of 123.90, sorry, 123.90. That's the first level of support from there. If we can move back above that 126.35, then we're looking at 130.25, and let me explain why. So here, that's the resistance level, okay? If we can close above 126.35, to me, that would demonstrate a likelihood of continued higher prices. But what you've got from there is kind of free air up to that 130 level. So 130.25. So looking at here, those levels for March, from April. So don't be surprised if we see a relatively fast burst of speed up into the 130s, which would be quite a big move. So keep an eye out for that one. And then finally, just a quick look at the euro against the US dollar. Been some interesting moves from there. We again hit a pivot point, that 1072, again, spiked it a few times, couldn't stay above it. And then here we are down towards those sorts of lows. Level now, 106.70. That's the next area. This sort of congestion of pivot points here. So 106.70 from there. The next to the upside is 111.23. Okay, so that's fine. There's some of the most popular markets there. Let's have a look at some of the trades that we had last week. It was fairly light on trades, but what we lost in perhaps a volume of opportunities, we certainly made up with quality of opportunities. As we look at the likes of the NASDAQ, we talked about this earlier. We had a buy trade here back on the 8th of May. That was a 1.45% winner, so really nice move for us there. The euro against the US dollar, that short was a 1.44% winner. We've already talked about gold being a 0.53% winner. S&Ps was, what we decided to do, we put a note out to our members to close the S&Ps for about a 1% profit on Friday morning. That actually proved to be the right play, because it did come down and then hit our initial stop loss. So we did really well on that with them as a 1% winner on what is at the moment a directionless, trendless, choppy market. So to come away with 1% on that opportunity, we're really happy with. But the big trade really was the Hang Seng. We had a short trade here on the 11th of May. That was a 3.7% winner. So all in all, 8.1% roughly up last week. That's from risking 2% of your account on each trade. So that's 5 really nice trading opportunities that we had that have closed out already. So there we are. There was a short 11th of May. and we're literally out of that trade in that first day. And look at the reversal. This is kind of what's happening at the moment. The market's a little bit indecisive, so we're looking at taking profits where we can, rather than trying to stay in them for 3 weeks, 4 weeks, because that can lead to a very, very difficult holding strategy, shall we say. For me, get in, get out, chalk up some profit, and let's move on to the next burst of speed. Okay, the final thing that I want to go through is just a very quick minute or two just to talk about, what's the problem. This week's problem, we're going to be talking quite simply about risk. One of the problems for a lot of traders is to set their amount of risk correctly. So what a lot of people do is they talk about risking maybe 1% of your account on each trade, 2%, something like that. Whatever that number is, it's got to be something you're comfortable with. If you were to risk or lose 1% of your account, would you be too bothered about that? I'm not, don't get me wrong, no one's going to be happy about it, but it is going to change your life. Probably not. So, for example, if you had £1,000 on your account, what would 1% of 1,000 be? Well, that would be the same as, that would be the equivalent of £10, okay? So if you had £10,000 on your account, that'd be £100. So you want to try and keep those percentages low, because what you want to focus on is what the chart is telling you, less so about the money side of it. The more you focus on the money, the more you're going to be trading it according to the emotional reasons to get out of a trade, rather than reasons that actually exist for anybody else in the marketplace. So how do we work out then what our trade size then should be? The easiest way to do that is to look at a sort of a triangle like this. Okay, so what you're going to do is you're going to look at your risk. So let's call that £10 at the top. Okay, remember doing it like this in physics basically. So you then got your stop loss distance, and then you've got your stake. Okay, so if you're spread betting here. So what this basically means is your monetary risk is here at the top. In order to work out your stake, it's your monetary risk at the top divided by your stop loss distance. That's the number of pips for your stop loss distance. So if it's 10 points is your stop loss distance, then 10 divided by 10 would be your stake, which would be £1 per point. If it was £10 risk and your stop loss distance was 100, 10 divided by 100, which would mean that your stake would then be 10p per point. Okay, so should be quite straightforward if you think about it in those terms. Monetary risk at the top, there's your sort of divided line. This is your multiplication line. So stop loss distance times by your stake would lead to your monetary risk, and then the number at the top divided by one of these numbers at the bottom will lead to the other one, if that kind of makes sense. Okay, so it's an interesting way of doing it. Work back from your account size, think about a percentage that you're happy with, 1 or 2% max, really, 2% max really of an account. Think about what your account size is if you haven't got one already. That'll provide you with a monetary risk. Are you happy with that monetary risk, or is it too much? If you're happy with it, then that's what you could look to stick at the top of that little pyramid there, or the triangle, and then you can think about that on a trade by trade basis. Okay, so whatever the stop loss happens to be for that opportunity, take your monetary risk divided by that stop loss distance. That'll provide you with a stake per point for that trade, which is nicely risk managed according to the risk profile that you're happy with. Far better to do it this way than just going hell for leather on various opportunities. Right, guys, that's it from this week. We will be back next week, actually, for the 22nd of May for our next podcast. Hopefully, it's going to be a great week's trading, and I wish you every success with your trading for the next few days, and see you next time. Thank you, and bye-bye for now.